Welcome back to Indianomics. We have been speaking with Sanjay Nair of KKR, Nikhil Shah of Alvarez & Marsal, and Pradeep Kumar, former Managing Director of State Bank of India, on whether we are at the start of a de-stressing of bad loan cycle in India. Mr. Pradeep Kumar, one of the problems that State Bank heads told us is that in an SDR case, I have 51%, so I am actually the owner, and every shareholder and employee now comes to me. I mean, I cannot run, say, a road company or a construction company. Do you think in such a situation, you now have an option with, say, a special fund set up by KKR or by the government, or a company like Marsal willing to do the running for you? Do you think now in an SDR case, you are having options to dispose it off in 18 months?
See, in an SDR, if I have to run the company, the bank cannot run the company on its own. We'll have to depend on people like Alvarez & Marsal or any other professional to run the company in the interim till we get a buyer. Of course, the best option is to get a buyer immediately, or bring in some investment from either any other special situation fund. That would be much better than going through the SDR route and having the equity for 51% and running the company for about 18 months. This would be a much better option if an investor is willing to come in immediately.
What is your sense, Nikhil, that SDR cases will be the ones that will be first resolved?
So, my sense is actually that as soon as the banks actually start to recognize the problem, that they will start to act like owners of these businesses. If you look at most of the businesses that are stressed, they've already gone through a round or several rounds of restructuring already. And now currently the loan values that are there are in excess of the enterprise value of these companies. There is no equity value actually in these companies. So effectively what we're saying is that the banks actually own these assets. Now as an owner of the asset, what should they do actually to maximize their value, right? They should set aside all issues related to the profitability impact, right, which is what the fear has been so far. And given what the government and the RBI are saying in terms of providing that capital to replenish their tier 1 capital, they should start actually acting like owners. They should start bringing in specialists to run the companies. They should start bringing.
Are you being approached by people in from the Joint Lender Forum or by the SDR, the banks running the SDR consortiums? So are you being approached? Are you seeing that action already?
We are actually engaged in a few situations already in an SDR route that has been taken by the banks. But I think that it's imperative that they bring in the specialists to actually run the companies, specialist capital like the KKRs and Apollos of the world, that can actually provide the necessary capital to get the companies out of the situation, and then look at how they can actually monetize that position over a period of time.
Okay. Sanjay, do you think that funds like yours can start off right away? You see the situation right?
I would say yes. This is the moment we are most busy. I would say last few months, I think we're going to keep the possibility of trying to do a deal very high. We have done 1 or 2 deals, but they are well before they went into the distress arena. So that's very good. I mean, that's recognizing a problem early and you have an opportunity, typically led by the management, which is the best. But talking of the kind of deals we're discussing today, I think there are some bidding situations going on. I think it'll boil down to finally what is the fair market value at which these will clear the bank's books. That is the key. And as he mentioned, that the rollover of the debt and the interest that they've accrued is so much more than 100 cents to the dollar, that 120 cents to the dollar, that there is no equity value. So it's going to require write down. And then I think that if the banks can have the 49%, the funds can have the 51%, and they have some faith, like all of us have faith, that this equity value will get recovered with specialist capital, specialist people. Maybe 5-7 years from now, there is enough to attach some value to that 49, so the bank can add that back to the haircut debt and say, okay, I got my money back. It's much better than having a vendor note from an ARC that's backed by limited capital, frankly.
Okay. Yeah, 5-7 years you said. Let me ask you something more tight. In the next 2 years, do you think, say, 10 cases, 50,000 crores will be resolved?
Yeah, I think so. So that's not difficult. I think there's ample capital available, there are ample specialists available. It's about the fair clearing price of these assets and then the cooperation of the management, the banks and the specialists. Absolutely. I mean, I think you can have a resolution of larger number in 2 years, and then it'll take 5 to 7 years to resolve them.
Fair.
And to say whether you succeeded or not. The success will not happen in 2 years. Deals can start, but
No,
success
I mean,
will take 5 to 7 years.
fair enough. I mean, for that, growth also,
Yeah,
I
growth
guess,
needs
has
the
to
growth.
lend a helping hand. Mr. Pradeep Kumar, what do you see as impediments?
I think basically the impediment is the promoter, his unwillingness to cede control, and two, maybe the fear of the banks that they may have to take a large write-down. As Sanjay and Nikhil said, debt and interest is more than the enterprise value. That fear of taking a very large haircut, maybe these are the impediments. But I think banks have understood the problem. Now I think they'll have to force the promoters to come to the table and cooperate in the process of maybe a smooth transition to the to either to cooperate with the new investors, be with the new investors, or totally get out of the company.
Okay. What is your sense, Sanjay? Will being tagged NPL force promoters to come to the table, or will it make them uncooperative and actually create problems?
I think it depends on how they see themselves in the society. Clearly being tagged as an NPL doesn't help them. That's the end of their business proposition. I think it also depends upon what the view they have on the economy and the recovery. I think there's inbuilt in all of this is, do I see a hope at the end of it that there will be recovery if I cooperate, and can I also get some money back at the end of it? So I think those two things matter a lot.
The ideal ownership structure would be probably a part of the equity held by the bank, part of the equity held by the private equity guy or the stressed special situation fund, and part of the equity held by the promoter himself.
Even overseas today, when these deals are done, I mean, something at the end can always be structured to be given back to a cooperative management, a cooperative manager. So that's market practice. But if you want to throw them out completely, that's fine. With the new rules, you can do that. But I think then, to Pradeep's point, you do have an irate promoter on your hands, and then you can be exposed and just delayed again and again. But I think that's a minor structuring issue. I think the broader issue is that all three stakeholders can work together, and I think that's a real possibility.
Okay. Do you see the situation resolvable, I mean, at least several cases resolvable as is, Nikhil? Or do you think you will really have to wait for the bankruptcy court to be passed?
So in my mind, actually, if many of these assets are actually sold from the bank's balance sheets, that's actually the potential for success, right? Okay. The fact that it's actually moving to a new owner that provides liquidity and new management perhaps in these situations actually gives these companies a fighting chance to recover from where they are. If they continue to sit on the bank's balance sheets, it will go into a recovery phase using the SARFAESI and basically a liquidation of these companies, in which case the recovery values are sub 10%.
Yes.
And that's well known, right? So any recovery...
So even without the bankruptcy code, can we expect a reasonable level of success?
Absolutely, it's a mindset. Yeah.
That's why I was saying that the resolution with all stakeholders together, if the problem is recognized, a bit of haircut is taken, flexible capital is brought in, and so are the specialists, there's a fighting chance because you have an economic growth in the country.
Yes.
Exactly.
So that is why you have the fighting chance. But the more you delay it, then that company is losing its brand value in the market, not marketing anymore, they have stopped their factories, there's labor unrest. By the day they deteriorate. So you have to now...
So I read this as a subtext that it is good that the Reserve Bank and the government are forcing the issue now. We have last 3 minutes for each of you. Issues that I may not have covered. Mr. Pradeep Kumar, last thoughts?
No, I believe that we are all moving in the right direction. The Reserve Bank, the government and the banks. I hope the promoters also realize that they are fighting with their backs to the wall, and the best way is to allow new investors to come in, cooperate along with the bank, and so that as you said, no, so all three have some stakes. The banks convert part of their debt into equity. The new promoter or the private equity fund or special situation funds put in money. The promoter is also there. He cooperates. And if all three are there, I'm sure many of the difficult cases can be turned around. And I have seen in the last cycle also that banks have been able to recover money after 5 to 7 years as part of the equity value goes up, and they are able to recover whatever the haircuts they've had earlier. I hope everyone sees the writing on the wall, and all three, I think the banks, the special situation or PE funds and the promoter can come together and resolve the issues.
Nikhil, any further issue you want to add?
I would just like to say actually that I think that the Reserve Bank, Governor Rajan, as well as the government actually has correctly identified this issue of stressed assets and actually trying to clean them up, because it's actually affecting credit growth in India. If you see, credit growth has been anemic in the last 3 years or 4 years, and the reason is actually this. And by actually cleaning up this situation, credit of course is the fuel for economic growth, and so if you don't have any credit growth, you're not going to see GDP growth going any north of where it is.
Absolutely. Sanjay, last thoughts?
I think just the last thought is there's got to be one or two examples established quickly.
Yes.
I think that will catalyze the process. And secondly, I think there is still one lacuna, which is one or two banks can't decide on behalf of the consortium, and that's just slowing down the process. I think we need a bit of a tweak from somewhere which empowers the leader of the consortium, whoever that is, to take a few decisive calls. Otherwise, I just also sympathize with the banks who have to entertain guys like us, and then they have to go worry with the 30 other banks they have and then try to convince different hierarchies. I think that's a mess.
At the moment, I think if 75% of the
but getting 75% is not that easy either, so it still involves 25 people.
So tweak the rule to 51%.
Yeah, whatever they want to do, I think just make it decisive, establish a few examples, and then see where it goes.
Okay. Well, thank you, Sanjay, Nikhil, and Mr. Pradeep Kumar for joining in this conversation. Key takeaways that we have is, one, all participants agree that forcing the issue was a good thing. The markets may have been very unhappy with the way in which bank shares have fallen, but forcing the recognition or reclassification of a stressed loan as a bad loan is probably good. That brings parties to the table. Second, all participants have agreed that we should see at least a dozen deals struck in the next 18 months, and probably those cases will get resolved in the next 5 years. The third takeaway, and an important one from Sanjay, is that probably rules need to be tweaked so that all the 30 banks don't have to be taken along. Probably if 51% agree, the rule should be so tweaked that decisions are forced. Well, a fourth takeaway, not all of them have said that we have to wait for Godot. In this case, it is a bankruptcy code. Even without it being passed, there is confidence that some of the stressed assets could get de-stressed, or at least the cycle could be started. So I have an answer to the proposition, to the question I raised. Are we at the start of a de-stressing cycle? Yes, all three of them say so. That's it on this edition of Indianomics. Thanks for watching.